Hello, everyone. Good evening to you on the 7th day of Executive Development Program. This is the last day, but we never say it as last. You know why? Because we want to ensure that our enthusiasm on this day is as great as it was on first day. We all know that your enthusiasm has been great with your wonderful feedback and comments. My sincere gratitude to ICAI President CA Nehar Jambusaria sir, ICAI Vice President CA Dr. Devashish Mitra sir, Committee for Members in Industry and Business Chairman CA Hansraj Chugh sir, Vice Chairman CA Durgesh Kabra sir, and CMIB Committee for under the leadership of Chugh sir and Kabra sir for having this program. This program, an enriching program for you, for faculties, for us, for seniors, for everyone, has been making a big difference in our lives. And I'm sure the 7th day of yours will be an exceptional day as the 6 days have been. Today we are on the topic corporate finance and valuation. Valuation, has become integral part of our lives. Why is it so? The reason I see, because we all are curious about valuations of startups. Many times we ask ourselves that the startup is making a loss, but why the valuation is so high? What is the multiple? These kind of questions, layman questions I see everywhere. Then, when the pandemic hit, the valuation of the organizations which was associated with e-commerce or doing online things like Zoom and other things, delivery business, significantly rose. Few days back, the valuation of Patreon was talked about when they had a Series F funding. And the valuation of the 4 organizations, the big 4, Apple, Microsoft, Amazon, Google, is exceptional. Similarly, the organizations, very often we look at the valuations of organizations like Facebook, Tesla, Netflix, Airbnb, Twitter, and this interests us. I have been connected with someone who I call as a valuation guru, who is very popular professor in USA, Aswath Damodran. I do not know when I got connected to him on LinkedIn. 15 days back, someone asked me whether you know him. I said, no, I do not know him. Many times it comes that you are connected on LinkedIn, whether you know him. So, but I feel myself lucky that I got connected to him on some time. I'm not sure whether it was 1 year ago, 2 years ago, or 6 years ago. Because now his followers are more than the double connections allowed on LinkedIn. So maybe 5-6 years back, I might have tried and I got connected to him. So there are a lot of his videos available on LinkedIn, and he quarterly or weekly or 15 days, he shares some reports, which sometimes I read if I get time. So those are brilliant writings. And similar professor we have today, who is not in US but in Dubai. And his name is Naresh Pafar. Naresh, I know, like I'm saying every day, that from how many years I know? Naresh, I know since October 2013. So how much time? Almost more than 8 years or so. And the first time I had met Naresh was I had met him with his wife. And he was a speaker in the conference. At that point of time, I used to volunteer with our Dubai chapter executive member, and I had the responsibility to drop Naresh at his home. So that was the first time I met him. We had an interaction in an Innova car, and since then the relationship has flourished. So allow me to introduce Naresh. Naresh is, as he likes to call himself, Ness, is a Wharton certified CFO and ADP holder. Cornell, New York finance graduate. WIPO, Switzerland certified in advanced IPRs. National rank holder chartered accountant. Qualified valuer. Mathematics City First. Economics National Merit, and Sir Raman awardee with 22 plus years of glorious international career in corporate finance. Merger and acquisitions, deal advisory, valuations, and ministerial special projects while working in USA, UK, France, Germany, Italy, Bahrain, UAE, and India. Naresh has led 620 plus international projects of up to USD 20 billion. Naresh has held key senior positions with Standard & Poor, PricewaterhouseCoopers, London, KPMG Corporate Finance, Dubai World, Crow, Soba Group, In5 Dubai, Founders Institute, JCC Regional Senior Leader, and National Gulf Group's Global CFO. He has many distinguished achievements under his profile. He was a steering committee board member for Dubai Government Startup Incubation, finance mentor for Sharjah Government Startup Studio, valuation trainers for Indian Government Ministry of Corporate Affairs, Ministry of Oil and Gas Assurance Project, Ministry of Finance and National Economy Special Project, he was a private assignment leader for Ministry of Seaports. He was involved as a project leader for stock exchange and rulebook formation. He was a senior leader for investment and growth in GCC region for world's largest startup accelerator, Founders Institute. He was a global leader for Indian investments in India's largest and fastest growing startup accelerator. He is a business mentor in GCC region for MIT USA. He is an industry advisor for higher colleges of technology in UAE. He was a blockchain and fintech speaker for Khaleej Times News Media. He was a global corporate advisor, special investments group member, STEP conferences, awards judge, Mecca CFO panelist, Pearson Global and Columbia University New York's finance coach, incorporate Chief Finance Presenter for Marcus Evans, VUCA Finance Presenter for Terrapin, FinTech Thought Leader. He is a distinguished guest lecturer in 7 leading universities. He has published articles on valuations in London's Global Banking and Finance Review, GBFR. He has trained more than 5,000 professionals worldwide on finance and valuations. And his Ivy League qualifications include, as I told you, Wharton, Cornell, WIPO Switzerland, ICAI, Babson's College USA, Berkeley University, Harvard University, and London Business School. So we have a very distinguished speaker today on a very interesting subject of corporate business, corporate finance and valuations. Before I ask you to give him a virtual round of applause, I want to quickly remind you that mentor and mentee program email will be sent to you. Please register for that, also for psychometrics test. And as always, do not forget to give the feedback for all our wonderful speakers, because our speakers are asking for it. So please give on the formal link which has been sent to you via email. So please allow me welcome with a big virtual round of applause, CA Naresh. Naresh, the floor is yours. Thank you.
Thank you so much, Prabdeep, for your kind introduction. Before I begin, I'd like to thank the chairman of the committee, Mr. Hansraj Chog, the vice chairman of the committee, Mr. Durgesh Kabra, and of course, many thanks to you, because you've been instrumental in arranging this program for the young students, and I salute your memory, which is 8 years back. You even remember the name of the car, which is fantastic. I'd also like to thank Mr. Ranganathan, Ms. Shalini. I've never met, never heard, but I'm sure behind the scenes a lot of work is going on. not in any sort of hierarchical order, but definitely I'll fail in my duty if I don't thank the President and Vice President of ICAI in India. So this is the last day of today's program, which is being organized by ICAI for the freshly qualified students. And the topic given to me was advanced corporate finance and business valuation. Now, this is a topic very close to my heart. I thought to myself that these are newly qualified people, chartered accountants. I thought if we make it advanced corporate finance, maybe it will become too technical or too advanced. So allow me to tweak the topic a bit. I would rather nomenclate the topic as basics of corporate finance and basics of modern business valuation. Before I begin, let me try and share my screen, and maybe one of the technical people can confirm if you can see. If somebody can confirm.
Yeah, visible, please go ahead, sir. Visible.
Okay, thanks a lot. I would like to dedicate today's presentation to two of my very beloved professors, whom I know very closely, and I've had the fondest of memories learning all my life with them. And since my chartered accountancy student days till now, I've kept in touch with both of them. One is Dr. Prasanna Chandra. You can see him on the left side of your screen. And the other is, who doesn't know him, Mr. V. Pattabhiram, the costing guru in India, costing and strategic financial management. The introduction given by Prabdeep was very kind. So I don't deserve so many accolades in terms of how high he rates me when he says that we have a similar professor to Dr. Ashwath Damodaran in Dubai. He is one of my closest guru also, Mr. Ashwath Damodaran in New York. But I'll take a little bit of credit for today's presentation, and that is I've had this chance of partly contributing in being part co-author for these two books that you see on your screen. One is Corporate Valuation, which is in its second edition. So I contributed a bit to Sir Dr. Prasanna Chandra. And the other is Beyond 2020. And this book can be particularly relevant for freshly qualified chartered accountants because it talks about 25 happening careers. So I think it goes in sync with even the theme of the entire executive development program. I'll highly recommend that students who are interested, both these books are available now, I guess, on Amazon. So make full use of the sharings here by leading experts. Let's begin with the presentation disclaimer. Today's presentation is purely for illustrative purposes. Views are my independent personal views, and they don't necessarily represent the opinion or guidance of any professional body. So please, audience, exercise your own professional judgment before you rely on any view presented here. Accidental copyright violation, if any, is unintended, as today's primary objective is to knowledge share and then mutually learn from each other. Expectation setting wise, I have a couple of promises to you. So I'll keep it like an evolving primer, which is just basic and introductory, which means it's less technical, that's like jargon free. IFRS and taxation scopes in depth are excluded, but we'll make some connotational sort of references wherever it's required. I believe I'm a big fan of pictorial representation, so it leaves an impact, it calls for better understanding. So the aesthetics and appeal of the presentation also is better, so then the recall and applicability is also good, particularly if you can think about practical perspectives that we wish to share in today's presentation. So what is this? Is this a technical glitch? No. This is a blank screen. So I invite all my dear fellow chartered accountants who are freshly qualified to today's presentation with a blank slate, sort of clean mind. So there's a Latin terminology for this, and it's called tabula rasa. Tabula rasa means if we were to wipe our mind slate clean, and then we learn. We are amenable to learn from a grassroots level, and this is how I would welcome each one of you as a child to this session, including myself. So the mutual sort of communication will lend itself to a better session experience today. In the words of the all-time legend, Sir Albert Einstein, he says, if you can't explain something simply, it means you yourself have not understood well enough. And I'm a firm believer of the same philosophy. And that's why in my first interaction with any audience class across the world, wherever I have trained, I keep it elementary and I keep it pictorial so that it helps my own understanding better with experiences that I get to learn from of others. And others are able to see the points that I'm making more clearly. So welcome to the iceberg principle. Finance today is a vast ocean of a subject. In a matter of a couple of hours, beyond doubt, we cannot touch upon every element of finance. My endeavor will be, in all earnest, to touch upon the tip of the iceberg today in terms of some elements of finance, which will be intriguing, which will make you more curious, which will help you better apply the basic tenets of finance that you've so far learned in the course of becoming a qualified chartered accountant. So before we begin, there are some time evolutionized new rules of the game. And let me take you through some of these. I heard oftentimes during the last couple of sessions that, there are these interview questions that are going to be asked. How many years of experience do you have? So first of all, that question as to how many years experience, that does not apply to you because you're fresh. And I totally belong on your side when you say that, okay, if we are fresh, how come we can be expected to have the experience? But the silver lining is the chartered accountancy course allows you the practical experience side by having your practical experience whilst you're studying, which is fantastic. But even after 2 or 3 years, let's say when you're qualified, and more so from an established professional perspective, in my own humble opinion, the question, how many years of relevant work experience do you have, is going to shrink significantly in its relevance, in its importance, in its significance going forward, because of the sheer pace of change the world is experiencing now. So the more the number of years of experience a professional is going to have, and particularly if he does not keep himself high on the learning curve, he is going to become redundant very soon. And you, freshly qualified people, coupled with the practical experience that you have, which our alma mater ICAI allows us to have, will be rightly placed to meet the challenges of today's evolving world, much better than what this question can give an inkling about a professional experience profile. So this is my own personal view. So get charged up, feel positive. You are way ahead than people in a lot of respects who have lots of years of work experience. So pat yourself on the back. Which car do you see in front of you? So let's make this session interactive. What do you see before you? Students, you'd like to participate? Which is the car brand model that you see in front of you?
I'll let you know the answers which are coming in.
Sure.
Yesterday, one student told me that, when they type, they believe that there's a time lag. Yeah, we have got an answer. Naman Jain, BMW.
Very good, Naman. So this is BMW car. My following question is, can anybody make a wild guess? One BMW car has how many parts? Just make a guess. how many parts are assembled together to make one BMW car? It doesn't have to be the right or wrong answer. I'm just tickling your mind before we begin.
Uh, 3,000 to 4,000. Naman says, Juhi says 20 to 25. ITS, just a guess, sir. Krishna
Sure.
says 100. Malika says 60,000. Siddhish says 1 lakh. Shezad says in tens of thousands. Pavan says around 15,000.
So,
Yeah, so the max. Yeah.
thank you, Pradeep ji.
Yeah.
So
One more big
participants
answer we have got. 8 to 9 crores by Anadi. Yeah.
So participants, fasten your seat belts. On an average, one BMW car has 5 million parts, which is 50 lakh parts, one car. The idea of showing you this picture is if one BMW car has this many parts, and other cars must be having equivalent number of parts, not as many as maybe BMW has. And if there is an automobile company, it has complete assembly line, it has all the systems, processes, it has the the rules to follow, the regulations, compliance, the financial angle to it, the pricing, the go-to-market strategy, so many things. Can you imagine how many factors one company will have to analyze, assess, and then decipher from and then decide on in reporting to us 1 year's performance? Huge, right? I mean, everybody will not be technical, but for a company as a whole, it's huge in terms of the number of pointers, whether technical, financial, commercial, compliance-wise, health and safety, HR, all put together. That is how complicated, complex, intricate, interconnected today's life is. And my earnest request will be to all of you, let's start thinking coherently. The number of interplaying factors in the world economy at large in this ever so globalizing day and age are going to have intricate interdependencies between and amongst themselves. So start thinking global, start thinking from a big picture perspective, start thinking about multicollinearity from your regression learnings, right? So this was one point. What picture do you see here? You see a car blazing past. I'm again inviting participation. Please let me know what makes a car go fast. What is that one thing, in your opinion, that makes a car go fast? Prabdeep ji, please let me know once you have response.
Yes, yes. I'm waiting. Engine and design. Naman says, Krishna says it's engine. Pavan says engine capacity. Malika says driver. Yeah.
Absolutely. The aerodynamics, right? Yeah, very good.
Sir, there's one question. Srishti is saying she is not able to connect the dots which you are trying to explain. Like she has a comment. Yeah.
From which question?
I'm not sure. Maybe.
So, Srishti, if you're talking about the previous slide, BMW car was just an analogy to tell you one car has how many parts. My point was more global in nature, where you have so many factors interplaying today. So if we just think in silos from our theoretical understanding, if we just look in our reporting function, if we don't look at things in an interdependent manner, in whichever company you'll be working, your understanding, your presentation, and your analysis and decision making, if you are in that position, will not be complete. That was my point. So on this point, on this slide, very good comments. So someone said the engine, someone said the shape, size, someone also said the driver of a car, which is very good. So basically aerodynamics. So same question was asked to a group of very brilliant students like all of you in US. And one of the students, to everybody's surprise, he got up, he raised his hand, he got up and said, it's the brakes of the car. The brakes. And then in the first go, everybody was surprised. But then they put on their intuitive thinking cap and started thinking about it, all of them, all the students together. Now think practically. If a car does not have proper brakes, or if it does not have brakes at all, let's say, will anybody be able to drive fast? Particularly in normal driving conditions. We are not talking about test conditions. We are not talking about runways. Actually, no. So it makes a reverse sense, but it makes an intuitive sense. So again, the key message here, which I want to drive home, is you all have just qualified. In my humble suggestion, don't try to run very fast. Take a break. Think, what you want to do. Choose your direction after a lot of discussion with friends, with experts. Maybe speak to mentors. Have some influencers support you. Even if you want to begin from a management training, it's okay. But, choose the right company, choose the right brand. You will have enough opportunities in your life to blaze fast. But breaks are also important in life. So Jeff Bezos, when he met Warren Buffett, he asked a very interesting question. Warren Buffett is, of course, was the richest man in the world, and now it's Jeff Bezos. But this question was asked when Warren Buffett still used to be the richest man. And Jeff asked, Warren, your strategy is so simple. Why doesn't everyone just copy you and then become rich? And Warren Buffett gave a very simple answer. He said, because nobody wants to get rich slow. So in a lot of respects, again, it points to the same philosophy. In this case, it was more about value investing, where Warren Buffett believes in making one right choice, one right decision after years of analysis, years of following a company. But once he gets into a company, he sticks with that company as a value investor. So this is also maybe a takeaway from two of the greatest men of our times. So what does a modern corporate finance era look like? Gone are the days where finance used to be just a support function, just a reporting function, accounting function, MIS function, compliance function. Finance today, in the whole scheme of things, has taken a center stage. Even the biggest of corporations in the world, particularly in the social media, if you think about, they all started as social networks. But today their biggest value comes from their being socio-economic and not just social media. To give you one example, when some new products are launched, one of the biggest go-to-market strategy is to have a Facebook page. So there is economic sense in their amassing the kind of wealth that they've got. In an organization, after the CEO, the most powerful position in many, many organizations in the world is the CFO position. And a lot of CFOs have succeeded in being promoted as CEOs. So finance is at a center stage in the world today. I'm a consultant to many companies, startups, large companies, large business groups, and also small and medium enterprises. This is an analogy that I have shared with many of them, that in my opinion, in future, there will be two very key important things for you to be quintessentially successful. At the inception, at the beginning, you need to be rightly and timely tech enabled. So which is your digital platform, your interface, your website, your mobile app, your go-to-market strategy, your digital campaigns, social media, and the right technology co-founder, the right tech interface. If you don't have that, in today's tech-led world, you already lost half of the battle. Now think about what I'm saying. In the early stage today, which are the biggest successes? FinTech, EduTech, Legal Tech, Agri-Tech, and I can go on. Health Tech. But tech, the prefix, is common in all this. So that's how important tech has become. And right from inception. At the end, as an end objective, you have to plan for an end objective, which is from a value maximization perspective. As a financial blueprint, as a financial strategy, as a financial plan. So all the processes, systems, people, resources will align together for you to be able to reach that end objective that you've carved for yourself. And then everything else will fall in place in between. So the core of a company, the product, the service, the marketing strategy, the HR, the compliance, the legal, commercial, everything else will fall in place. But this is another way to look at future from key success parameters perspective. So CFO today should have, these are the USPs of being a leading CFO. You need right people skills, your technology skills. You need to have a global perspective, like I said, the interconnections, the analytical frame of mind. You need to understand the importance of data because data is exploding. By one statistic, the world has added to itself in the last 3 years an equivalent amount of data that used to exist before those 3 years. That's the pace at which data is getting added to the world. And we are at the fastest pace of change in our lives. But believe me when I say this, we are also at the slowest pace of change for the rest of our lives. So things are only going to get faster and faster because right now what we are seeing is only the realms of human possibility of how fast, how efficient, how better, and how instant gratifying things can become. Let the dawn of artificial intelligence come. Let the dawn of quantum computing come. Let the dawn of directed acyclical graph, DAX structures come, which makes the traction, the speed limitless. And that is where the bigger financial sense or bigger financial benefit that you as finance leaders of future will be able to bring will be only from your understanding of these tenets, which will make you stand out in the crowd, particularly from a data perspective. And these are all the technologies, your machine learning, artificial intelligence, your big data, blockchain, RPA, which is robotic process automation. I can think about decentralized finance now, atomic payments, fintech successes. That's artificial intelligence for you. So what it will do, in my personal opinion, let us not live in a false sense of security. Artificial intelligence in its full bloom will take some more years to manifest. It will be by the year 2025 or 2026 when you'll begin to see the real implications of what AI can do. And there's no doubt that it will replace a lot of jobs also. If we think jobs will not be replaced, we are misinformed. So it's all the more important for us to be on the learning curve, to have our USPs, to learn AI, rather than taking this as a negative or to fear from this age and this era is coming. Like I was listening to one of the previous sessions, and one of the participants mentioned that even ICAI can think of introducing some programs in the machine learning or artificial intelligence or blockchain realm, because this is future. This is going to have the biggest impact that we have seen in our lifetimes and we are going to see in our lifetimes. So why not? So these are some statistics from an advanced economy where these high percentage of digital strategy and the amount of automation that they are planning. If you see from this, most of the automation is being planned around chatbots, robotic process automation, advanced analytics, machine learning, artificial intelligence. So these are areas where if you focus and then learn some of these tricks. My dear friend Jay was also mentioning some basic analytical tools like Power BI, Tableau. These are fantastic data analytic and data visualization tools. You should learn some programming languages like R programming language or Python. That will help you a lot in your career, to my mind. So let's get to some basics of advanced corporate finance. This is how I like to call it. So what you see here is a pen. If somebody were to ask me what could be the value of this pen, let's say let's talk about Indian rupees. We would say, let's say 1,000 rupees, because it looks elegant. Yeah, we don't have the full visibility, but it looks like 1,000 rupees pen. What about this pen then? So here, this is a different pen, but here it gives you visibility from a different angle. It shows you the logo. So you know just at first sight that this is a Mont Blanc pen. And now this can go to a couple of thousands. It can even go to a couple of lakhs of rupees. Because now you know that this is a branded pen and one of the top-notch brands in the world. So branding of a company, branding of a product, branding of your profile in terms of your certifications, in terms of your unique experiences will go a long way in your life. Another takeaway from this slide is if I were to just say that the pen that we saw first, which is this pen, was recently used by Aishwarya Rai to give an autograph to a fan in the crowd. Suddenly you will see that the pen to your left will, if it's auctioned, will fetch more price than a branded pen. So that's the significance of influencer. That's the significance of social media. That's the significance of how you can align with people who are influential, who are powerful. This will also help you in your career. It need not be a celebrity, but it can be some leading veteran in our realm, which is finance industry. So this is the value paradigm from a corporate finance perspective, where my main intention was to tell you that there's a huge premium that a consumer assigns if he understands that it's a strong brand. Does this chart look familiar? In corporate finance, let's say you are the CFO of a company, or let's say you are any finance professional in a company, or you are an analyst with a stockbroking firm or a research house. You see good news. Let's say good news was a company has declared a 40% growth in profits, but the share price goes tanking. Has anybody seen this kind of a stock price behavior? If yes, then please can you share with me why, in your opinion, how can this happen? Despite there being good news, the share price should have rocketed, right? But many a times it also falls.
Yeah. So, reason they have to tell, right, Naresh?
Yeah.
That why it may be? Yeah.
Yeah. Why, despite good news about a company, many a times we see share price falling.
They got one day a speaker, I think Rajiv shared the example of movie Bazaar. He asked whether you have seen that or not.
Yeah, sure. So I think that could be one point, which is more around manipulation and insider trading.
Right. We have
But,
we have few answers now. Naman says because it fails against market expectations. Harneet says volume of shares sold. Pawan Kumar
Excellent.
Singh, I think, is giving example Alok Industry. Tejas says Infosys because price had already factored in the good news.
Very good.
Vivek says no, sir. Vaibhav says yes. Diksha says yes. Maybe the company is winding up.
So very good. Pradipji, I already got all my answers. So you assembled a fantastic audience group, I must say. I got all my answers. So sometimes it's manipulation. Sometimes it's insider trading, price is rigged. Sometimes it's low volume. Sometimes, it is doing very well, but it still falls short of expectation. That was the main point I was trying to get. So the, expectation is such a big spoiler, and nobody can tell you that better than me, because my immediate predecessor who was presenting was Sir T.P. Anand, who in a lot of respects is an inspiration for me. I've learned a lot of things from him, and I sort of role model him in a lot of respects. So he set a high bar before my presentation today. And in fact, all the presenters, starting from Gulneet Chadha. So I'm sitting on a high expectation bar today. The expectations are to be factored, and then if you do better than expectations, then you are a star. At this stage, I'd like to take a step back and then say to all the new qualified CAs, our expectations from the elder fraternity of chartered accountants, from you young professionals, is high. So you are, in a lot of respects, also on a high expectation setting. So do well. Now, how about this? 2020 was an exceptionally unprecedented time in human history, but you saw markets are at all-time highs. I'm sure the audience is super brilliant, so they will have some reasons or answers for this also. Can I invite some participation here? When I say markets, I'm talking about share markets, property market, crude oil, precious metals, almost all asset classes. It defies logic, right?
Right.
A lot of businesses went out of shape. They went delinquent, they went insolvent, they were closing, bankrupt. But if you look at the financial markets, they were near all-time highs in 2020.
Right. So we are expecting some answers from them, right?
Yeah.
Malika has made a comment. Yes, sir, we will give our best. Acha. Anadi says share price is based on shareholder expectation. If shareholder expect more than the company can earn, share price will goes down. Preeti Sharma says optimistic. Jui Goel says healthcare market. And Dharma says IT company maybe. Pavan says because of high demand after market falling prices. Rohit says expectations will lead to good things as well. Aniket says future prospects are positive, which get factored in share market. Tejas says liquidity driven rally and discounting vaccine and green shots in the industry. Jitendra is saying
Fine.
India is a growing economy. Yeah.
So great answers. 2020 and even now, and maybe even next year, will be exceptional, unprecedented, unforgettable time periods. So in a normal setting, all your answers could have been right, but not so much right when we are talking about this exceptional time in human history. So the single most significant factor to fuel markets at their all-time highs across asset classes is liquidity. Because the governments are injecting more and more liquidity. Otherwise, the economies would have crippled under the pressure. It was the sheer pressure was so high. And for the first time, a lot of money from institutions has entered into markets because the core businesses were taking a hit. So liquidity.
Naresh, I think there are 4 or 5 students who have given similar answers. I think Tejas, liquidity driven. Dave says
Sure.
government support and financial assistance. Maybe
No, I
some
heard
others
that.
also if I missed. Yeah.
Sure, yeah. I heard Tejas say liquidity and then I started speaking, which was phenomenal.
Yeah.
So this is a core principle of corporate finance. In fact, one of the most basic principles of corporate finance, which says that if you have the option to receive, let's say 1 lakh rupees now, it will be worth more than receiving the same 1 lakh rupees next year or after 2 years or after 3 years. Simply because if you have that money in your hand right now, you can invest that money and then earn a return or a yield on that money, so that after that time period you will have more money in your hand as opposed to receiving the initial amount of money after that time period. So what's the main takeaway? If this fundamental principle is so simple to understand, what's the main takeaway here? So we will not accept every fundamental principle on its face value. My endeavor will be to take you through certain scenarios in practical life where basic tenets or the basic principles fail to apply. Now let's say time value of money. Under what scenario you think time value of money can function reverse or it will not apply? So I can give you one example. Let's talk about the same time frame. We are talking about 2020, 2021, 2022. Not so much so 2020 because a lot of people were taken unawares and you were not expecting worst of times in 2020. But let's say we are talking about beginning of 2021. I wouldn't be surprised if a lot of people were given the option to receive X amount of money in the beginning of 2021 or at the end of 2021. A good percentage of people will choose to receive the same amount of money at the end of 2021. Simply because in 2020 they saw many businesses shutting down, many startups closing, many people losing jobs. And they felt that the default risk was very high. In whichever asset class they would invest, you don't know, the markets were sitting at all-time highs despite the pandemic. It's just a question of time before there's a huge nosedive. So under such extraneous circumstances, where the public have a lot of data points, which can give them a good probability of making sense that these will be tumultuous times, the plain vanilla concept of time value of money does not apply or applies in a reverse fashion. So the whole idea was to take you to the basics and then give you one example of how to think differently in different times. Risk return trade-off, right? So we've heard this. This is also a very basic tenet in corporate finance. So here it talks about equivalence of commensurate risk and return for the level of perceived risk undertaken. So many important words here. Equivalence, commensurate, perceived, undertaken. Yeah, but you get the message. So broadly speaking, the principle says higher the risk that you envisage, higher should be your expected return. And if you perceive a lower risk in any asset class, you may do well to still to just accept a lower return. But is this always applicable? Again, if we challenge the basic tenet and try on ourselves to think Is this always applicable? It may not be. So I'll give you an example. There are two friends, A and B. Person A buys an apartment in a building for 1 CR, 1 crore. And the time when he buys, property market is at a upper end of its economic cycle. So property markets generally follow 3 to 4 year cycles of peaks and trough. So person A, when he buys, the property market is almost at a higher end of the cyclicality. So following the cyclicality, the property price is correct. And the person B, who is very close friend of person A, buys an apartment in the same building, same locality, same building, same floor, maybe same view also, because they are so close, they want to buy next to each other, at the corrected price of 70 lakhs. And this happens after a period of 1.5 years since person A invested. As the markets were following their cyclicality, in about 1 year's time, the markets rebound and the prices of those properties now become 1.4 CR. And both of them, having tasted a market fall, decide to sell their respective properties. Who do you think in this case took higher risk and who made higher return? Obviously, person A, he invested at the peak of a time, so he definitely took higher risk, knowingly or unknowingly. He waited for a longer period of time in the loss zone, so it was also having a pressure on himself. Person B invested at the right time. So if you look at the kind of returns, A would have made around 40-50%, 60-70% returns, whereas person B doubled his money. And this happens not just in this extraneous kind of circumstance, many a times. Sometimes by luck, sometimes by timing, sometimes by patience, sometimes by insider report, sometimes by mentor guidance, sometimes by experience, sometimes by becoming specialist in a particular area by practicing for a very long time. If you master the art of making higher returns with lower risk, that's when you will be able to add value for yourself as professionals, for your companies, for your family businesses, for your startups, for your clients. This is where you'll be able to give better advice. And I can think of tens of other examples, but in the interest of time, we'll not get into many other examples. So if you plot the risk return on an X and Y axis sort of plane, you see where it starts from, cash and cash equivalents to then riskier asset classes bonds, and then riskier than that is property, and then riskier than that is stocks, and then I could say riskier than that is startup investments, riskier than that can be cryptocurrencies. All right. So that's your x-axis. As you move from left to right, the asset class respectively, relatively are getting riskier and riskier. On the y-axis is your expected return. So generally speaking, as you move from left to right on x-axis, you should expect to receive a higher return. Otherwise, please don't move from left to right. My dear friend Jay shared the Dupont analysis, so you all are very much aware of the Dupont analysis. I just wanted to reconnect on this analysis framework, because the key benefit of Dupont analysis is not just in breaking the whole formula into buckets and then making an analysis, which is very much there. But I'd like to give you a perspective of how intricate this one framework can become. So you saw the formula in the previous slide. Now you see the breaking into finer details from right to left. So whether you analyze Dupont framework from a return on investment perspective, which is for the business or company as a whole, or you just analyze this from a return on equity perspective, which is from a shareholder's perspective, that really doesn't matter much. But here, what I'm trying to say is when a company performs better compared to its own past, that's one way of using Dupont framework, or a company performs better than its peer group in the industry, in the geography, in the country that it operates in, that's another way of analyzing Dupont framework. So it's the same way when you go from right to left, but every time you just split the the parameter into its factors, and then as you move leftwards again, you break them into smaller and smaller categorizations. If I were to go one step leftward again, I would say by all the account codes or so many different types of inventories, your raw materials, your work in progress, your finished goods, right? Your receivables by maybe age, your cash and cash equivalents. You would say cash in which geography, in which bank, in when you say cash equivalent, you could be marketable security, so it will split up again. Sales of which product, cost of goods sold, so many items. There could also be trading income, other income. So Dupont framework is so powerful that if you have done better or if you have done worse, it helps you zero down on the exact bucket from which the biggest contribution has come to your better performance or to your weaker performance. And it becomes so easy and I would say so to the point that you can set the course right, particularly if you're not doing well. And even if you're doing well, it helps you analyze which is the biggest contributor to your doing so well compared to your past performance or compared to your peer group in the industry. That's the power of this framework, a very powerful framework. This is again a very interesting concept in corporate finance, which is called opportunity cost of capital. We understand it, but when it comes to application, many of us apply it wrong, and that's why it was important to bring it in today's forum. If I may ask the participants, what in your opinion is an opportunity cost of capital? Anybody?
Before the type, I would like to tell some students are reminding me that their questions are left. I will search it out, Malika, Srishti, and if it's possible to type it again later, because now when you are typing questions and a lot of comments are coming, it becomes difficult to juggle. Now we have a comment.
To take any question anytime.
Yeah,
as and when you have a question in your mind, feel free to stop me. We can address it then and there.
Right. We have a question by Dharma who says cost of losing next best alternative. Harneet says next best opportunity lost. Shehzad says cost of Y on undertaking X. Nithil says second best alternative. Preeti says cost of losing the opportunity of investing in the next best alternative. Yeah.
All of you are bang on, very right. So this is then it makes my job easier. But the problem is when it comes to application, most of us are not able to apply it right. Let me give you one example. So somebody says, somebody who is not a finance specialist, he is asking you as chartered accountant, saying, I want to value this particular share because I want to invest in it. What is the discount rate I should use? Because I have the cash flow projections, I want to use a discount rate and then I'll be able to value that share. And we all know that the discount rate is an opportunity cost of capital which we can use to discount the projected cash flows of a particular share. So as experts, we ask the layman, saying, what would you have otherwise done if you did not invest in the share? So the gullible person, he says, okay, I would have invested in a fixed deposit, in a bank fixed deposit. And then you would say, okay, if it's fixed deposit, a normal rate of return you would have made net of tax on a fixed deposit would be, let's say, 7%, just for argument's sake. So that is then your opportunity cost, because by wanting to invest in this share, you're foregoing the return, the yield that you would have otherwise made on the next best alternative, which you would have action taken, sort of, which is 7%. So use 7% as the discount rate. If the potential investor had used 7%, he would have seen a huge intrinsic value of the company, but the price at which it would have been available would have been much cheaper. So he would have thought, okay, it's undervalued, he's getting a very good deal, and he would have invested in that company. I'm not saying all of you will make this mistake, but I have seen in my career many people applying this concept wrongly. So all your responses were very right, but add to it a small caveat. Opportunity cost of capital is the return foregone on the next best alternative with similar risk characteristics. That last part was missing in all your explanations, and that last part is something that we fail to apply in real life. So now think about it. Investing in a stock or investing in a bank fixed deposit don't have similar risk characteristics. So we cannot use, that's the reason why we cannot use the FD yield or the FD rate of return to discount the cash flows of a company that you want to invest in and then you want to value. I hope my point is clear. So when it comes to application, there are small points which you should note down. That's where it will help you in your career. I repeat, opportunity cost of capital is the return on the next best alternative investment with similar risk characteristics. That's the important part to note, the last bit. Whilst we are on the subject of discount rate, we all know capital asset pricing model by now. And the formula is your risk-free rate of return plus beta times your market risk premium. So the first part of the formula is risk-free rate of return. Let me ask the participants today, most of you, whoever has, got interest in this subject, whoever has done it practically, in your CAPM model, in your capital asset pricing model, the first factor is risk-free rate of return. What to your mind would you use as a risk-free rate of return? Any participation? Again, we'll have a very interesting takeaway from this.
Yeah, I'm checking, Naresh.
Sure.
We have government bonds. I'm not sure for this government bonds rate. Juhi says, Sudesh says government bonds rate. Anish says RF beta. No, Anadi says RF beta. Gobind says treasury bonds.
Excellent.
Yeah, Treasury, then many Nitesh Treasury, government bond Tejas, rate on government bond Nikhil, risk-free government securities Preeti, bank
Excellent.
FD rates Rohit. Yeah.
Excellent. So I got all your answers are right in concept, in theory, in sessions like this, to deliberate, all your answers are right. Again, when it comes to application, it will be wrong. That's why I brought this point again here. Let us say you're talking about Indian government bond, or for that matter, any government bond, because most of you are from India, I'm talking about India. Generally speaking, most of the people will tell you for the risk-free rate of return, use the government treasury bond or the government bond yield as the risk-free rate of return, because these are sovereign bonds and there is no risk. You'll be surprised to hear and note every government in the world, to my mind other than USA, every government bond in the world has two components which make for the government bond yield. The first component is the actual intrinsic risk-free rate of return. The other component is the country default premium, the country default spread or sovereign default spread of every country. Now that's the problem. I would tend to think if India's bond rate as of now is 8%, somewhere around 1.25, 1.5% will be the default spread. So for you guys to apply risk-free rate of return in the right manner, you will have to reduce from the government bond rate this premium that is there for the default risk, because then it is not in true sense a risk-free rate of return, because there's a default risk there for which there's a premium inbuilt. So that is why it becomes so important that at the first step of your embarking on a discount rate, which is a risk-free rate of return, you should not make an error. So you may ask a question, what happens to the premium? That premium should get added somewhere as an alpha later or as a part of the market risk premium, which then gets accentuated because the second factor is multiplied beta times. So that's the technical answer for that. So cash balances, in our individual capacity or any company having high cash balances, it's normally considered very good. Is it always good? Having high cash and cash equivalents balances, let's say on a company's balance sheet, is it always good? What's the signaling that it is giving to the investors? Generally speaking, if a company will have many profitable avenues to deploy, to reinvest, it will not sit on large cash balances. So if you have very large cash balances, it's a signaling to informed investors who are smart investors that the company is short of growth avenues or profitable opportunities to invest. Or the company has so much of cash, but it's not declaring high dividends. So generally speaking, it's okay, following the cyclicality of the market, for a company to not have growth avenues or attractive opportunities enough to invest. It's okay to have those cash balances. But in those periods, companies should declare special dividends because that's their time to give back to the shareholders. If they don't do both, that's a problem. Think about it another way. Normally, any cash and bank balances of a company are not in savings accounts. They are in corporate checking accounts or current accounts, as we understand. And current accounts don't give any yield. There's no interest on the current accounts. So even if you think about this angle, by sitting on large cash and cash equivalent balances in your current account, a company is from an inflation perspective, it's losing money. So having large cash and bank balances are not always to be viewed as a positive in case of your corporate finance understanding. In fact, it's a weaker signaling. Many a times. I'm not saying always. We all know what is working capital. But if I were to ask most of you, you will tell me working capital definition from a balance sheet perspective, which is good, which is current assets minus current liabilities. But working capital in a layman's understanding is the repetitive operating expenses, the repetitive operating cost, right? So the likes of your rental, salaries, whatever you need to keep your business in motion, keep it up and running. That's working capital. Coming back to the balance sheet part, in our financial statement analysis or ratio analysis, we are also always told that if you have a positive net working capital, it's good. Because then your current assets are greater than current liabilities, and the positive working capital is good because your assets are more than your liabilities, the short-term ones. But is it always the case? Is negative working capital always bad? In fact, you'll be surprised to hear that not always, and in many cases, it's a function of the industry to which the company belongs. If a company belongs to, let's say, a retail industry, if a company belongs to, let's say, education industry, schools, for example, you will always receive either money in advance or you will receive money and you don't have accounts receivable so high. So your current assets, particularly the non-cash current assets, will always be insignificant in these industries. But on the other side, you will have suppliers with whom you have a payment float. So in these industries, you'll have a negative working capital, but it's very good for this industry. In fact, it's an enviable proposition. You get all your money paid in advance or paid in cash upfront, but you have the float to pay your suppliers, let's say in 3 months, 4 months, 2 months. And that float is interest free. To that extent, you need to borrow less from your banks. So negative working capital is not always negative. We always say the income statement is called profit and loss account. Have you ever seen a income statement where you have the profit and loss both? We don't see that, right? So why do we call it profit and loss account? Why not profit or loss account? I mean, the right nomenclature should be profit or loss account, right? In any given period, you'd either make a net profit or a net loss. The reason for this is a statement for a year is an aggregation of so many transactions, so many items, so many multiple times of transactions. Sometimes you make profits, sometimes you may make a loss. So on a whole, as an aggregation, you may get a net profit or a net loss, but during this time cycle, you may have made many profits, you may have made some losses. And that is why the statement for the period is called profit and loss account and not profit or loss account, because it's a statement. I mean, very elementary, but food for thought. This concept EBITDA, it's never failed to sort of surprise at least me, I would say. If you think about from a financial reporting perspective, or from your standards any financial statements that you have seen, you never heard about the term EBITDA. So what happened is, if all of you now close your eyes for a moment and think about, visualize an income statement in front of you, like Prabdeep ji mentioned about scenarios of startups where you don't have many a times profit at the bottom line, but they still have high values, right? So this was a similar kind of zone in which a lot of companies found themselves in, and they had to work out a way. So there are many companies in the world which are at a net profit or a net loss. At that net level, they are loss making. So then they go back one level up. They say at an operating profit level, which is nothing but EBIT, earnings before interest and tax, let's see if we are positive there, then we can use a multiple, which is nothing but enterprise value to EBIT multiple. Even at the EBIT level, if you are negative, what do? You want to then go to the concept of EBITDA, because then you add back the depreciation and amortization and it becomes EBITDA. And many times companies are positive at the EBITDA level, so it helps the consummation of the transaction in an M&A perspective. Now you may find operating income and EBIT in financial reporting statements. You'll also find net profit, profit after tax, profit before tax, but you won't find EBITDA. So it's not an IFRS terminology, but in deal making, this is one of the most prominent terminologies. And the quintessential or the principal reason for this is many companies were not making profits at the bottom line, at the net bottom line, or at the operating level. So EBITDA came to the rescue. And that's the concept. If you see basically the difference between operating profit and EBITDA, you can say that for acquisition decision making, EBITDA is generally used, whereas EBIT is more used by analysts to understand the profitability of a company. So there are differences in my opinion. For you to understand what EBITDA is, in a simple manner, think of it as, if EBIT is operating profit of a company, which is earnings before interest tax is the operating profit of a company, think about EBITDA as the cash operating profit of a company. Just that's it. EBITDA is the cash operating profit of a company. If you try to understand it this way, I think you'll never forget the concept. So what does this graph tell you? You know, if you see the trend, if you map or if you chart EBITDA margin and EBIT margin of any company for a long period of time, what you will see is the gap between the two lines narrows down as you move into the future. What is the signal that it is giving you? The signal it is giving to us is, in the early days, a company needs to make greater reinvestments or greater CAPEX investments. And then as you move forward, you still have to make CAPEX, you still have to make investments, but they are more for the, the ongoing repairs and maintenance or for the upkeep. As you go forward, because your CAPEX cycle, your CAPEX amounts or incremental requirements of CAPEX are going to come down, so your depreciation and amortization is also expected to taper down. And that's why you will see the gap between EBITDA and EBIT margin over a longer period of time will get narrowed down. There will come a time where the gap will be insignificant. It will almost be same margin. So also think about it intuitively. Also think about it, what's the difference? Also think about it, what will happen when you think about a company over a long period of time? And then think about, in financial reporting standards, what is that we represent? What is the ratio analysis that we use for presentation? what's the most important parameter that you use for deal making, and how all these things come together. This is a very interesting chart. So when I say franchise, what will come to your mind, generally speaking, will be the franchise agreements, whereby you become a franchisee of a strong brand. But in corporate finance, franchise has a different meaning. Franchise here means competitive advantage, your moat, your USP, your unique selling proposition. So when I say a large company has a strong franchise, in corporate finance, it means it has huge competitive advantage, which is unreplicatable by its competitors. So the same term that we use here many times, but it has a different connotation in CF. Value itself can be looked at from so many angles. It's your ease of use, durability, your design, variety, quality, price, customer retention, reliability, so many angles. But if you were to ask me which is the most important value paradigm comparison, it would be the comparison between value and price. At least that's the one which can be quantified and deliberated on, and you can reflect on it. Talking about the way IFRS defines value, now in the fair value standards, in my humble opinion, with due respect to the valuation setting bodies, the definition of fair value begins from the point that it is the price. It says it is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction, market participants, measurement date, knowledgeable and willing sort of participants, under no duress, under no compulsion, and taking informed decision, right? Which is good. It's a very good definition. But maybe I have an inhibition. I have a sort of humble opinion about this, saying I beg to differ that value, whether it's fair value or any other standard that you can think of from a value paradigm, it can be anything but the price, in my opinion. In the words of the legend, price is what you pay and value is what you get. If value was equivalent to the price, perhaps in the first place we'll not pay the price, or we'll have many other options. We'd not choose that route also. So when you try to make a normal purchase, from a value perspective, knowingly or unknowingly, at the back of your mind, you have to have some sort of value calling, which has to be incrementally higher than the price that you're paying for it. Particularly for the items which are optional. For your non-discretionary, it doesn't apply because you have to go for them. Again, coming back to the balance sheet, we say we generally say assets are very good and liabilities are bad. Now think about this. Are all the assets good? Let's think about what we have learned as the definition of asset. So asset, according to what we have learned theoretically, is asset is any property that is owned and controlled by an enterprise, and then the enterprise can expect to have future economic benefits from that asset. All right, good. Let me share with you today a practical definition of asset. So don't use it in your exam, but use it in your practical mind for your personal and for your client sort of decision making. I would say I would subscribe to that side of the group which says that an asset is any property which from the time you invest in it starts making money for you. Makes intuitive sense, right? It's logical. I repeat, asset is any property which from the time you invest in it starts making money for you. And liability is any commitment which from the time you get into it, you have to keep making money for it. So let's for now keep these definitions in our mind and think about the common categories that we call assets. Now, what's a motor car? Think about a motor car. From the time you get yourself into owning an asset called car, you have a commitment in terms of EMI, most of us, the registration of the car, the insurance, the repairs and maintenance, garage, cleaning, parking, the toll gates. So just to own a so-called asset called car, we have to start making incrementally higher money to make good the commitments. Cash is something we already discussed. At least in the case of a company, it sits idle in the current account making no return. So it doesn't make money for me. In fact, if I factor inflation, it's destroying value. Inventory on any given date. So all my stock that during a particular period I've been able to sort of advertise and promote and sell is good stock. But what is unsellable and what is lying idle, we have to call it stock. Not always, not fully, but maybe a percentage of that whole inventory will be unsellable. So we cannot say all the stock is my asset because you tried your best. You also made promotions. There were discount offers, but it's unsellable. So all your stock is not your asset. Same with your accounts receivable, your debtors. The customers to whom you sold, either they paid in advance, they paid within the credit time, and that went into your financial statement cycle. They were good debtors. A lot of these debtors can be old. Maybe you need to have provision for them. Maybe you don't have those provisions. I'm not questioning the pillars of financial acumen, what we understand as principles of finance. I'm just trying to say, also think about the same categories, the same segments from another practical perspective. And maybe it's a food for thought from a different angle. Same way, are all liabilities bad? Now think about the creditors, and we already touched upon this. Creditors, particularly for those companies which enjoy the privilege of having negative working capital, is a boon in disguise. Because if it was not for these creditors, they would have had to borrow short-term borrowings from the banks and they would have paid interest on it, which would also add to their leverage into the company. So creditors for these kind of companies are not bad. In fact, they are a boon. The so-called loan or borrowing, which is again classified under liabilities, what it does is first, the interest that you pay on the loan is tax deductible. To that extent, there's a tax saving for you. And the bigger thing is, after tax cost of debt is so much lower compared to your cost of equity. Oftentimes, it will be 2 to 3 times. Your cost of equity will be 2 to 3 times of your cost of loan. So in your whole scheme of things, when you compute your, WACC, weighted average cost of capital, And if you have a proportion of your capital structure in the form of a debt, by virtue of it being at such low cost, it brings down your WACC significantly. And if your WACC is lower, your discount rate is lower. If your discount rate is lower, the value of your company is that much higher.
Yeah, Naresh, there's one question. Anadi is asking you to repeat liability definition.
Yeah, so liability, in my practical sense, liability is any commitment which from the time you get into it, you need to start paying for it. Or in the sense of, what we are seeing now, liabilities can also be looked at those commitments which help you save from the more sort of cumbersome commitments. For example, if you did not have creditors, you would have to go for bank borrowings. And creditors are not interest bearing. Let's take the difference between the net book value of a company and the market capitalization. In this case, I've used the case of a Coca-Cola company, and this was a couple of years back. But regardless, I think for our analysis, it's still okay to see this chart. If I were to ask most of the participants, why do you think the net book value of Coca-Cola is so low as compared to its market capitalization? What would most of the participants like to answer?
Dharma is saying V-K.
What is that? V-K, is it?
Yeah.
Participants, can you please write the full word?
Nikhil says future expectations. Tejas says asset light model. And Preeti says future aspects are covered in market capitalization, whereas PV is historical cost. Gobind says
good.
The DBVW nominal value and MPS. Sudesh
Good.
says setting up a Coca-Cola now will cost a lot more than when it had cost earlier. Aniket says book value is historical cost while market capitalization
Okay.
is current.
Great. Your answers are very intuitive and I love all the answers. But let me share with you practically, not just for Coca-Cola, for a vast majority of the largest companies in the world, the primary reason for such a big difference between book value and market capitalization is intangible assets. When I say intangibles, they are a very broad category of assets. But within intangibles, a big proportion will be intellectual property rights, which is your patents, trademarks, copyrights, your trade secrets, geographical indications, brand name, human resources, and so on and so forth.
Yeah, and Naresh, Shweta at that point of time had written intangible assets. So many comments had already come in, so I could not read how.
Very good. Shweta, well done. So what I can say is, and most of these intangible assets, the IPRs, are not reflected on the balance sheet unless they are acquired by virtue of an acquisition, an M&A transaction. So when you pay for it by way of your purchase price allocation under IFRS 3 business combination, you can bring the acquired intangible assets on your balance sheet. but your self-generated or internal intangible assets are still not on the face of the balance sheet. At best, I can see in the notes to accounts some disclosure about your brand name value and HR quotient value. But good participation. And in that respect, very good formula for all of you to use will be Tobin's Q. So James Tobin came up with this formula where he used, the market value, but not just the equity value, the market enterprise value divided by the replacement value of the assets, not the historical depreciated book value of the assets. A very interesting formula, James Tobin's Q. So once you, in the denominator, make your base at replacement value, and still if you have a very high multiple in the form of a Tobin's Q, that's a better reflection of what is the realistic intangibles quotient of a company than comparing it just with the depreciated asset base. That's the whole idea. Another point which is very important and very significant, and oftentimes we use them interchangeably, is return on invested capital versus return on capital employed. They are not the same. If you see the formula, return on capital employed is different, return on invested capital is different. So what is the difference and how to use them in your corporate finance decisions? Imagine a balance sheet. On your liability side, you have shareholders' equity plus borrowings of 100 million, whatever currency you like, 100 million. Now that's your capital employed. Out of that 100 million, let's say you're investing 80 million in a project. And that 80 million will be represented on your balance sheet asset side, let's say as property, plant and equipment fixed asset. It's a manufacturing company, let's say. And the balance 20 million is, let's say, cash sitting on the asset side. Very simple. Very simple scenario. So the return that you will be making as your operating profit, and when you take out the tax from that, it becomes a NOPAT. That has to be divided by the invested capital and not the capital employed to have a sense of the profitability. Because something that you have not even deployed, the balance 20 million, you cannot add to the base. But there is still another, the top formula, which is ROCE, which is your operating income divided by capital employed. Then what's the use of that? In corporate finance theory, it is generally understood that a company should take up any new project only when the return on that project exceeds its weighted average cost of capital. I'm sure all of us are aware of this. If the return on a project is going to be less than the weighted average cost of capital, we should let that project be foregone. We should not go for that project. For that comparison with WACC, with WACC, your ROCE is relevant. But if you want to analyze profitability of a company, your ROIC becomes relevant. That's the distinction. So I've given you the difference in formula, I've given you the analysis difference, and I've given you practically which metric to use at different analysis points in corporate finance. So I've got a small case study here that there are two companies, both of them make 1 crore of profit. Company A actually invested 50 crores because it bought the place and the equipment. Company B used, it leased out the property and used and employed used items, which is second hand. Now, if you look at it, the profitability of company A will be just 2% because it invested all the 50 million. It purchased, bought. Whereas company B made the same profit, which is 1 crore, but it invested only 10 crores. So its profitability was 10%. So that much can be the difference if you employ the wrong formula or the wrong parameter in the metric. So here the idea was to analyze the profitability, and you can see the range diversity between the two companies, which on the face of it are making the same operating profit of 1 crore. Anyway, I'll leave this slide in the presentation that I can share so you can have a look at it. So what you see in front of you is financial statements. At the top, I've shown you the income statement, which is your profit and loss account. At the bottom, you see balance sheet, which is assets and liabilities. Let's try and get, into the underlying layers of what meets the common eye. Let's say on asset side, you can see what you see is, let's say, a cash balance. But as an underlying layer, that is liquidity. That's the intangible element of this cash balance, what you see on the face of it. On the liabilities, let's say you're talking about convertible bonds, for example. So the intangible underneath layer is convertibility. As opposed to a non-convertible bond, a convertible bond has a higher value because of the convertibility option. So that's the intangible layer of it. Let's say sales or revenue or income. So the underlying layer is brand name. When you talk about your salaries and wages or employee benefits, your recreation expenses on the expenses side, the underlying bigger intangible, the iceberg principle, right? So the berg is actually human resources. You can ask me what's the difference between the two. So generally for product companies, brand name is a bigger proportion of their value. For service-oriented companies, a bigger proportion of value comes from the HR quotient. So if you think about it this way, almost every item on the face of the financial statements will have an underlying layer. And if you understand it from that perspective, you will be able to add greater value in the corporate valuation framework, corporate value framework rather, in an incremental manner. Because these are the bigger value proportions, and we will see that in the slides to come. So I like this pyramid, this triangle a lot. It says top line or revenue is vanity, which is for showcasing. Bottom line or profit is sanity, because that's the sense we want to make out of it, how much profitable it is. But then ultimate reality is cash flows. Oftentimes, you will hear in corporate finance, the net present value formula. And I've read in so many books, so many searches, that a company's value at the end of the day is nothing but aggregation of the net present values of all the projects that it undertakes. Is that connotation true? I don't think so. Simply because in this NPV formula, where we have a minus of the initial investment and we have the discounted values of all the future cash flows. If you think about it plain vanilla, the valuation is only the first compartment, the first component. This is the valuation. So if you sum all the NPVs, you're not going to get to the value of a company. So always when you read something, always put your own mind to it, try to understand it by formula, by your understanding, by application, by trial and error, by seeking guidance. That's how you learn practically. Otherwise, you will misemploy a lot of tools. So we understood that cash flow is reality, and then we say free cash flows, not profits, are key. And we have this framework of discounted cash flows, where we project the cash flows in the future, and then we bring them all back to the present value. And then we call that's the valuation of the company, which is something we also saw in the previous slide. Now, how true or how applicable in current times is a DCF methodology relevant in arriving at the intrinsic value of a company? It is by far the most widely used method to arrive at the intrinsic value of a company. But in the current tumultuous times, in the current VUCA world, in the current fast-paced, evolving, quick obsoleting world, where people like instant gratification, where people change their minds, where the pricing strategies are so dynamic, where your go-to-market segmentations have to be wrong, your minimum viable products and product market fits gets thrown out of the whack in no time. Think about it. You are at time zero, and because the corporate life is assumed to be perpetual, you're taking a call on the future projections, and not just the future projections, the risk profiling, the growth characteristics, the discount rate that you're going to use. You are, in a different sense, assuming that you're going to be associated with this project, or you're going to link yourself or continue with this project forever in perpetuity. That's not the case. Companies terminate joint ventures. Companies abandon projects. Companies change strategies about a significant investment. And that's where a plain vanilla DCF model realistically has stopped giving you the relevant valuation that you're looking for. And that's where the real options valuation domain is catching frenzy. So real options adds the flexibility of abandoning a project, contingent scalability of a project, dynamic pricing modeling, simulation, all those, your Black-Scholes pricing model, which gives you the option to exercise, not the obligation. All those models are gaining in prominence, and DCF is becoming less and less relevant because the world is getting so much varied and dynamic. So this was another perspective I wanted to share with all of you. Here are some common myths, and then we do a reality check. So what revenue is very important, your top line, your sales is very important. But then what is more important than revenue is to be able to sell profitably, at least at a gross margin. You don't want to undercut to an extent where you start bleeding and gain market share. Growth is important, but what is more important than growth is being able to grow profitably. Because there is no fun in diminishing value by, keeping on growing. If you're not able to, compete otherwise in the market by innovation, by differentiation, by USPs. Just by cutting prices, if you are not profitable, your growth is meaningless. In the example that we discussed earlier, if your return on capital employed is lesser than your weighted average cost of capital, your growth has no significance. So you need to be able to grow profitably. Yeah. Your profits are important. Yeah.
Yeah, Naresh, there are 3-4 questions. Once you finish your point, I'll let you know. Yeah.
I'll just finish this slide and then I'll take it. So profits are important, but cash flows are more important. Cash as a balance is very important because it helps you make use of an opportunity that may arise all of a sudden. But what is more value accretive than cash is deployed cash, the cash that you have reinvested back into the business or you are planning to reinvest back into the business. Again, assets are very important for any business, but then what have gained bigger proportions within assets of any company are intangible assets and intellectual property rights. So I won't call them myths, but if you do a reality check, if you do a practical sanity awareness check, what you see on your right hand side, if you focus on those, you will be able to be much more successful in your professional careers, for the companies that you will be working for. Yes, Pradeep.
Yeah, Malika is asking, can you explain invested capital in more detail?
So I gave an example where a company has raised 100 million. Now that 100 million can be a mix of equity and debt in any proportion. Forget the proportions for now. And you have invested in one project, but you have not invested full 100 million. You have only invested 80 million. So the balance 20 million is sitting as cash balance on your balance sheet. So at the end of the year, let's say you're coming to talk about your net profit, or you're talking about the operating profit. If you want to analyze the profitability of your company, you can only analyze on the capital that you invested, not on the capital that you have raised on your balance sheet. That's the whole point about profitability.
Yeah. Further, she has commented that in one of the case studies you use, in this case, shouldn't lease cost be part of profit and loss, and only machine value should be taken as invested capital?
Yeah, so what you take as so this is not about a treatment. This is about a corporate strategy. If you outright buy a full asset, and as opposed to it, let's say you use them need based, for example, just in time, or you only pay for it. It's not necessary just by leasing. If you just use something need based, or if you outsource the non-core assets, if you are able to, instead of buying new factory products for your own manufacturing process, instead of that you buy second-hand refurbished items which are able to give you, along with warranty, equivalent amount of quality, whichever way. If you are able to get the same profit by investing fully, then your return metrics will vary. That's the whole point. So it's really not about leasing or not only. Any other question?
No, there was a comment which Mahesh had made. ROCE is on the funds provider's point of view. However, ROIC is actual return on the amount used to get earnings.
Absolutely. Absolutely. That's why in corporate finance, where you compare with WACC, weighted average cost of capital, always compare with ROCE and not ROIC. Good. So I will leave the slide open for a while. And if I can take like a 2 minutes break, Pradeep, it's okay?
Yes.
So this will give you an idea from 1975 till about 2015. If you look at it, the proportion of value that is now contributed by your intangible assets and intellectual property rights has gone from 1/6 to 5/6. And that is why it has become such a prominent field of corporate application, corporate financial strategy, even study, and still it is not manifested in many ways on the face of the balance sheet. But in reality, it is such a big proportion of a value. And that's where, if you recall, there was a huge difference between the market capitalization and the net book value of the company from your historical accounting convention treatment. So allow me a break, audience, for 2 minutes. I'll be right back with all of you.
Yes, if any questions I have missed, request you to please type it back, and my sincere apologies for that. And I hope that you are getting it, you are understanding it, and wishing you very best. I had one question for you to ask quickly until Naresh comes. I had seen a very good comparison where a person asked that how much time an each company took to reach 100 billion valuation, which is not inflation adjusted. So the question is, which company you think must have taken less time, Google or Apple, to reach 100 billion valuation? Google or Apple? If anyone wants to participate, can type in. Google, Malika says Google. Yes, Malika, you are right. Exactly. And Google took 7 years, a few months, and Apple took 31 years. So, but we all know that Dharma says Apple. Dharma, Apple's valuation is the highest now, but Apple is a very old company, right? It has a history of so many things. But yes, its valuation is highest in the past few months. It has remained highest, 2.2 trillion US dollars. Yes, so Naresh, our faculty, I think Naresh is about to be back. Even, Facebook, I will tell you, give you comments. Facebook took 8 years, Amazon 17 years, Netflix 20 years, Microsoft 21 years. There's another interesting fact I would like to tell you, which is from a book, Story Outliers by Malcolm Gladwell. And he says that mostly the one who had founded great IT companies in 1970s, they all were, like those who were of the 70s, 80s, they all were born between 1953 to 55. And when they were in teenage, 17, 18, 20 years old, so they were having a good access of the IT field being developed. And that made a difference, like this Microsoft founders, Dell, HP, many other companies. Yeah, Naresh, thank you.
Thanks, Pradeep, for allowing me a break. Yeah.
Yes.
So wonderful so far with all of you. Let's move forward. You see, there are fallacies in today's world which manifest in many ways from a corporate finance realm perspective. So the real value, the intrinsic value, is losing its shine, losing its significance, which is your fundamental value in terms of your, the practical assets, your cash flows, your intellectual property rights. On the right-hand side, what you see is transactional value is manifesting itself more. So when I say transactional value, I mean the valuation multiples in terms of a pricing. By the way, if you ask me personally, and this is not my find, this is these are the words of wisdom of the greatest visionary in corporate finance of our time, Dr. Ashwath Damodaran, and I am his one of the biggest followers. And according to him, out of the so many approaches of valuation, where you have income approach, market approach, and the asset approach, actually the market approach is not an approach of valuation. It's a pricing approach. That's because what we, at the end of the day, basically do is to take a bunch of pricings and then price our company accordingly. So it's more of a pricing game, according to him. And I totally agree with him. Particularly when the markets are hyped beyond beyond, the deserved zone. There is hype in the form of information technology, biotechnology. You had a lot of other hypes earlier. There's, the concept of FOMO, this fear of missing out, and excess liquidity, of course. And these are some of the reasons why, even in the worst economic conditions globally, you see asset prices at all-time highs. This concept we already covered, that data is exploding in future.
Right.
And that is where data will become the new oil. And particularly from your perspective, if you can get yourself into the data analytics or big data kind of zone with data visualization, you will have an edge above your peer group. So what we saw in the penultimate slide before now was a world of excesses. It was excess liquidity, excess fear of missing out, excess price game, excess hype, right? So if we have to quantize this in terms of alphabets, I've used excesses. It's time for us to move from excess to wise. When I say wise, we become more prudent, we take informed calls, we become more rational, we try to understand the basic substratum reality and not just follow the herd mentality. I would like to ask the audience group, from the time COVID has struck the world, from the early part of 2020 till now, what to your mind or what in your opinion has been the primary business focus shift? I mean, what were the key principal corporate objectives in your mind prior to COVID, during 2020, and as we speak now? Just think for half a minute and then send me some responses. It will be amazing to get your views.
Yeah, Naresh, by the time delegates think, I want to pass on a couple of questions to you, if you can make a note.
Yeah.
This question we
Sure.
have been getting every day by, I think, Rohit. He wants to pursue a career in investment banking, equity research and valuation. So whether CFA or MBA is required or CA is sufficient, and what he
Investment
should do
banking?
now. Investment banking, equity research, valuation, so etc., like related fields. So this is his question. If you can answer later, I will give you another one also.
Sure.
Harneet was asking, what is your view on CAPEX to OPEX paradigm shift?
Very good.
Yeah, and one more question was there. Where is that? So Nikhil is asking whether the sessions are available on YouTube. Yes, Nikhil, sessions are available on YouTube and also on this webcast link also. Under recorded webcast, you can see. Shubham had made a comment, expectations on huge growth in sales. I think this is, I'm not sure what time he made it. And Malika is asking if you could throw some light on relative valuation. Right?
Yeah. So we are going to cover it, relative valuation.
Yeah. So now I will read out the comments. Liquidity, growth to survival, digitalization, prior 20 growth, in 20 stability and e-commerce. This is Malika is saying. Then Himanshi is saying e-platforms. Mithilesh is saying digital marketing. Aniket says prior COVID growth 2020 prior COVID growth 2020, survival 2021, recovery and new strategies or diversification. Aneet says business objective shifts from profit focused to survival focused. Dharma says changing workforce. Vigil says logistics have been severely due to COVID. COVID business were looking to expand and grow. Now businesses are looking forward to move ahead and overcome the COVID pandemic. Yeah.
Guys, I have to admit, this is one of the most brilliant batches I have come across. So kudos to all of you.
Yeah, one more question I need to give you. Harneet is
Yeah.
asking, are there enough opportunities, are there job opportunities for CA freshers in technology related? Yeah, if
Fine.
you can comment, otherwise I will get that answered to her separately from another faculty.
Sure. No worries. So let me just finish talking about this slide and then I'll answer the questions that were raised by Pradeep ji. So as rightly pointed out by many participants, earlier the focus was growing your top line or revenue and profits, both. And then as the reality was setting in, even if there was no growth followed, but at least they wanted to keep selling on profits. Companies, businesses. And then came a time where they would sell even like not just status quo revenue, even declining revenue, even at losses. And then came the time where it was a calling whether you would continue or you would want to close down. So the focus all of a sudden shifted to your survival question. So in valuation realm, the going concern premise over a very short period of time had to change to sort of a liquidation premise. There was one deliberate thing that was I kept missing in this, which was a focus on digitization, which also some of the participants have alluded to. So fantastic! I'm really happy with the participation. So, if I can answer the questions, I think Rohit asked about a career, career that he wants to pursue in investment banking or equity research or valuation. So, Rohit, investment banking, at least in the entry stages, is more of a data entry, number crunching, analysis, report writing kind of a role. So, for our chartered accountant background is particularly suited for an investment banking role. So at an entry point, I don't see any problem in a CA getting into it or not. But as you would grow, as you would want to grow within investment banking, and then many people who are in investment banking, they vie for a positioning into venture capitals or private equity. That is where the challenge will come, because that is where it's more a domain of CFAs and MBAs. So this is my answer for you. But at the entry point, you are best suited to be in the number crunchers game, because as opposed to an MBA or as opposed to a non-chartered accountant, you will be in a better position to read the financial statements and take the right numbers along with the sense that you can make out from the notes to accounts, and then give your valid inputs. CapEx to OpEx, Harmeet, definitely. So the world is moving from, full sort of CapEx or full cost base to enterprise SaaS models. So which is where your need-based use, only the number of licenses you want to use, even, your office space, you'd only pay for the number of hours that you have used. So it's more about need-based economy, and that's where the world is shifting from a full involved or full committed or full invested rather capex ecosystem to an opex need-based instant gratification or just in time, or paying for the variable time or resource that you are using kind of a space, which is very good. The question that you had about can finance people move into technology space? Why not? But then don't move to a technology space plain vanilla is my advice. You will do very well to pursue a program in Python language, and a lot of financial applications these days are developed in finance using Python or R programming language, and also it will help you get an edge in data visualization and data analytics. If not, then at least you should do some program on data analytics side or on blockchain side, big data, and use some tools like Power BI or Tableau, once you do that, you will be able to move into a space which is an admixture of finance and technology. Plain vanilla technology movement is definitely not the right option for us. But if it's an aggregation of finance and technology, it could be a fintech player, it could be a payment solutions player, it could be an analytics player, it could be a KPO. So these kind of enterprises, if you follow these additional programs, you do exceptionally well, to my mind. Right. So at a base level, valuation is defined as a process of determining the current worth of an asset. So life can only be understood backwards because we can look at hindsight and then pass on many judgments, but it must be lived forward. The same is the case with valuation. You can understand much better about a company only from the past experience, right? And the past financial statements, the past performance. But valuation is future oriented, forward looking. And here are, I've kind of summarized for you in columns parameters that increase value, parameters that reduce value, parameters you can use to improve the value and then diminish or, enhance the value. I'm happy to share this. So go through this at leisure. This is a very interesting pyramid by Paul Flegnor. And if you have to summarize valuation process or valuation exercise in one frame, in one slide, then this pyramid way of understanding it is very good because the base is always broader. So you need to understand the purpose of the assignment, the objective, then the business description, then the valuation premise, the standards of value to use, then the compliance and the legal framework, the regulatory framework of any business, the business, the operations of a company, then the financial performance, and then comes the approach and the methods of value that you may want to use, and finally comes your report, valuation report, which is a deliverable. Now, valuation is not a certificate, it's a matter of your opinion, and valuation reports don't necessarily have to be in writing. In many advanced and developed countries, including USA, oral submission of valuation report is also acceptable, even in a court of law, right? So let us look at each of these buckets in a bit of detail. So when I say purpose, let's start from the first box, which is the purpose of a valuation. Valuation can be used for many purposes, and not just the ones that are highlighted here. So it could be used for financial reporting, of course. Like I said, purchase price allocation under IFRS 3. It can be used for marital dissolution, divorce case, mergers and acquisitions, of course, your stock option plans, reorganizations, bankruptcies, joint ventures. In a startups world, you want to evaluate your startup to, welcome a co-founder on board, to plan equity, not just as ESOPs, but restricted stock units, RSUs for a, startup team. So you use valuation, you need valuation in almost every realm. Sometimes it manifests explicitly and sometimes at the back of in the valuation paradigm anyway. Valuation premises. So there are actually, you'll not find such a wide description of valuation premises in many textbooks or even Google searches. But this is the widest so far that I have come across. So there is a premise of highest and best use. Then there's a going concern premise. Then, value in place, which is the assets assemblage, and then the liquidation premise. So liquidation premise itself can be forced or orderly. So what it does in a nutshell is the highest and best use is actually the value in the best case possible. If all the parameters were best, what could be the best possible value of a company or a business or an asset? Going concern is nothing but how it is actually being used. How are the parameters actually aligning in practice? So that's the value in use. Where you have brought together all the assets, but you have not yet started operations. So for example, a startup, let's say example of a SME. So the operations have not yet started, but the facility is ready in terms of an asset assemblage. So there the asset assemblage value in place premise comes into play. All right. And then the liquidation. So normally you will only hear about two premises, which is your going concern and then the liquidation. But in the widest way possible, you have to understand that these are the premises possible. So liquidation is only when a business is not expected to continue to be living, where you need to liquidate. And there's a difference between orderly and forced liquidation. So in an orderly, you are waiting for the best offers. In a forced liquidation, whatever you get first. All right. Standards of value. So there is a fair market value, investment value, intrinsic value, and fair value. Fair value is generally used for financial reporting. Intrinsic value is more used for your research and analysis by research houses, and then they say based on the intrinsic valuation, based on the current market price, whether a stock is undervalued or overvalued. Investment value is more transactional, and fair market value is for general assessment. And you just want to know, without getting specific as to someone wants to buy or not, which is not transactional. It's just general assessment, which can be discussed, which can be used to make presentations, general understanding of the valuation framework. So that's where the fair market value is more commonly used. A very important concept in valuation is the effective date of valuation. So any valuation that is more than 5 to 6 months old is actually stale, and a valuation report, standard practice in any report, it's not appropriate if you don't have the date of valuation mentioned in the report. So effective date also is very important concept in evaluation. Now there are so many factors, in the valuation world, so many factors affecting valuation world. One of the participants was asking, she was not very clear about why the BMW example. Now think about how many factors can affect valuation of a company. Now that same company, if it was BMW itself, there could be technical factors, there could be procurement factors, there could be product differentiation factors, financial, compliance, legal, resource, HR, commercial, environmental, so many factors. And you never know at which point of time, which factor will become overbearing. So all I'm trying to say is there are exceedingly large number of factors that have an interplay on, that have a bearing on valuation. And increasingly we are seeing more and more intertwined sort of impact on valuation. If we have to see in a nutshell, what are the main internal and external factors affecting value? You got the net worth of the assets, the earning capacity, efficiency of management, the nature of the businesses, the dividend capacity. External factors are more macroeconomic, political and social, demand, supply, economic policy of the government, more to do with the externalities which are beyond the control of an enterprise only. Now just looking at these factors, whether internal or and external, there is one factor which in my opinion has the highest impact on valuation, but it is missing in this slide before you. I'm welcoming your thoughts according to your opinion. What is that one single largest contributing factor having the largest impact on valuation, but it is missing in this slide? It will be interesting to hear your comments.
Yeah, before they type, I would like to pass one message. Hanif wants to ask that why CFAs are more preferred than the chartered accountants for investment banking jobs. And
No,
this
so
is one.
yeah,
Yeah. Yeah, and one more question is there. Is I want a managerial role in this is Nikhil's question. Is MBA necessary? If I want to do MBA, I should do now or after some years of industry experience. Yeah, this is
in my opinion, for a managerial role, you don't have to necessarily do an MBA. And if you wish to do an MBA, the best would be to first have an industry experience of at least 2 years and then go for an MBA. So that's the second question answered first.
yes.
To answer the question of why CFA is better suited for investment banking, CFA is all about financial management. It's all about corporate finance. It's all about capital budgeting. It's all about valuation. It's all about deal making, right? It's entirely about that. In CA, you have, at least when I did, in final we had 8 subjects, and one of the subjects was MAFA. So that explains it. Investment banking is a core transaction-based corporate finance realm. And that's the only reason. Otherwise, in terms of rigor, CFA is also not difficult, is not easy to clear. And CA, of course, is not easy to clear also. It's just about a core specialization focusing so much on that transactional aspect of finance.
Yeah, we have few comments, Naresh. Malika says cash flow, Dharma says goodwill, Aman says goodwill. Yeah, that's it. Not many have answered this.
Yeah, good. So cash flow is not a factor. It's what you use to arrive at a value, and goodwill is a component of value. It's not a factor that affects the value. So we are talking about causation here, cause and effect kind of relationship. Right. So the most important factor is here, growth. And which is where Prabdeep was mentioning initially that although companies that are making losses, they are valued at such high prices. And then they make exits, the deals are happening at such high valuations. Also, Infosys, when it came out with its IPO in 1995, after that, it was not profit making for some time. But what Infosys always used to do was to grow at a minimum of 60 to 70% in its infancy, quarter on quarter, year on year. And that, when you compound over so many years, becomes a huge value proposition. In my mind, if anybody were to ask you in any interview or anywhere in your practical application, what's the single most important factor affecting valuation or value of a company or a business or an asset, it will be the growth of the company. Now, growth needs to be understood in a deeper manner. So look at this picture. What do you see? We obviously do not see the vast entrenched roots of the tree underneath the earth, but what we see is the stem of the tree and the leaves and how far it's grown in the outside world. That's what is visible. But if you see, and this picture of course is not to scale, in reality the roots will be even much wider and deeper. So even for growth, you need to understand this. Again, linking back to your iceberg principle, what you see is just the tip of the iceberg, but the berg itself is so huge, and that's the underlying substratum that holds the iceberg together. Same way, the wider and deeper the roots of your growth, you will be able to withstand the vagaries of time. You will be able to come back even if you have some bad years. So growth itself, when I say growth, I mean the sustainable growth. And sustainable growth will come more from the depth and the width of your underlying strength. Same way, also from an iceberg principle perspective. So because we are talking about sustainable growth, the formula for sustainable growth in corporate finance is retention ratio into return on equity. That is, if you have to understand sustainable growth from an equity shareholder's perspective. if you have to look at a business as a whole, from an enterprise perspective, the same sustainable growth rate formula will become, instead of retention ratio, you will say reinvestment ratio. And instead of return on equity, you will talk about return on investment. Okay, but regardless, so this is the formula for sustainable growth. So if we have to understand value the way we are trying to understand, so on the right hand side is value. We want to go deeper into the causation as to what is the biggest contributing factor to value. It is the growth, which is what we understood. Now, based on the formula that you saw for growth, at least from a sustainable perspective, what will be the cause or what will lead to higher growth? Like I said, from a business as a whole perspective, either your reinvestment rate, it's a product of reinvestment rate and return on investment. Equity perspective will be retention rate into return on equity, but I'm talking for a business as a whole. So because ROI multiplied with reinvestment rate will give you growth, so to have higher growth, you either need higher ROI or you will need higher reinvestment rate of return. And over a period of time, you know, from the EBITDA versus EBIT chart, what was very evident is over a period of time, your CAPEX, incremental CAPEX requirement will fade down. So over a longer period of time, reinvestment rate contributing to growth will get lesser and lesser. And that's why I marked it in red here, which means over a long period of time, higher growth at an enterprise level of a business will generally only come from return on investment. So the higher your return on investment over a long period of time, higher will be the growth, and thereby you will have higher valuation of the business. So if that is the case, when can you have higher ROI? ROI itself is a function of operating margin times capital turnover. So if you will have higher operating margin or higher capital turnover, you can have higher ROI. But when can you have that? It means what? It means either you are able to sell the same quantity as your competitor but at a higher pricing, or you cannot charge higher price. You all have to charge the same price, but you are able to sell a greater volume. Now, if we want to get to the last layer, saying when are you actually able to charge higher price, or when are you able to sell greater volume or greater quantity at the same price, it will be because of your brand name, or in the case of a service company, because of your HR quotient. So if you look at valuation this way, you see how deep we have gone, layer by layer, and then what it throws up is that your intangible quotient, brand name, your HR, your patents, your trademark will help you have the moats, the franchise, the competitive advantage, because of which you will be able to not only charge higher or sell more, but you will be able to do that same over a long period of time. And that is why it's no surprise that the 5/6 of current valuation of the largest enterprises is manifested in the form of intangible assets and intellectual property rights. So I thought this is a very good way of understanding value determinants, going deeper layer by layer, right up to the last stage, which is intangibles and IPR stage. So somebody was asking about the approaches. So broadly, there are these approaches: market approach, cost approach, income approach, contingent claims approach, which is all the real options that I mentioned. Negative approach is something that you will never find in any Google search or something. This is my, I can say this is my copyright because I'm coming up with a book. This is more from a litigation value perspective. But to make it simple, we just talk about the three broad approaches, which is your income, market, and cost. In income approach, typically you ask, what's the worth of a company's future economic benefits. From a market perspective, what is a comparable company priced at? I won't say worth. In cost approach or the asset approach, you look at, how much are the assets of the company worth? At the end of the day, that's what matters. Now, no projections are required generally for the asset approach. Income approach will require projections, and market approach may or may not require projections. Well, it may require projections if you're using forward multiples. If you're using forward PE, for example, in which case you will not need to know the projected earnings. And that's why you may or may not need projections. And these are just some applicabilities where, mature business will use a particular approach, whereas not. Cash flows currently or expected in the future. When you are expecting cash flows, you will use discounted cash flow model, where the major portion of value will come from not the cash flows, but a market pricing. You'll use relative valuation model. If your asset or business is so unique, then you use DCF. If there are a large number of similar businesses, you will be better to use relative valuation or your market approach. Now, this is a time horizoning of the whole thing. If it's for a very short period of time, you want to enter something and then exit in a couple of months, then your liquidation premise and approaches under that will be holding good. As you go longer and longer term, in a discounted cash flow, that is at the end of the projection plan period, which is at the end of the horizon period, you have a concept of terminal value, which is from the end of that horizon period up to perpetuity. That's the job of the terminal value, to capture that value. So when it's for a very long-term horizon, discounted cash flow will come to the rescue. And when markets are generally neutral, they are not hyped or they are not biased, then relative valuation is good. But if markets you think are hyped or they make mistakes, then DCF will give you better idea about the intrinsic value of a company. Again, the similar concept here. These are broad categories of companies, but I'll not spend time on this. I'll leave it in the slide deck that I'll share with Pradeep later. This is very important. So I think the whole, like we saw the valuation pyramid, if we are, for today's takeaway, if you just take this one slide, you'll do very well for yourself. And this is where most of the practical experts will falter. Because it's not the way you should, in a normal, in a specialized environment, you cannot do a valuation of a company just by the financial statements. You will make some projections, you will use some discount rate using a wrong opportunity cost of capital, just like that. And then you'll say, okay, this is the terminal value, and then we discount everything back. This is the value of a company. Macroeconomics have to be factored. Industry parameters have to be factored. Every company is unique. You need to factor. Where is most of the value coming from? You'll be surprised how much value will actually be lying hidden in their intellectual property rights. Every company is different in its life cycle. A company can be 2 years old, another company can be 50 years old. One company will be just beginning its rapid growth phase. The other company will be in a mature stage. Another company will be dying out. My whole point is, if you look at the pedagogy from this slide, understand the business life cycle of the company. Understand the horizon period and how you want to stage the growth during that horizon period. Understand the cash flows, like one of you was mentioning. Then how you want to time the pattern. What's the risk profile of the asset or the business of the company? What are the growth characteristics? How would you compute the terminal value? Then do a sanity check, because always it's better to follow multiple approaches and multiple methods. If not for using, at least for a sanity check. Do a benchmark check. And finally, the valuation report. If you follow this pedagogy, your report will stand out. And of course, you need to follow the international valuation standards. You need to, make sure that, your method is congruent or in line with the expectations or the objective of the particular project, but this is very important. So remember, I was talking to you about the life cycle of a company. Like every human being, when a child is born, from that time to his infancy to adolescence, and then becoming an adult, and then youth, and then you grow old and mature, and then finally you retire, and then a human being dies. Same way in the life of a company, there are these stages. So there's a launch phase, there's a growth phase, there's a shakeout because of obsolescence or disruption because of the evolution of technology, which is so fast and rampant. Then there's a maturity. So after the shakeout, a lot of competitors enter that market, and then there's a mature phase, which then tries to decline gradually. And from that decline phase, you may either want to, you may be able to reinvent or enter into a different business segment as a group, or you die down, your natural death. So whole idea behind sharing this, the life cycle with you is when you see the financials of a company, you have numbers only for 2 years. Just on the basis of that, you cannot tell at which juncture point of this life cyclicality that business is. But it is oftentimes so important to understand how old is the company, the competitive landscape, and that is what will help you in having the right financial projections in the first place. Forget applying the right discount rate, forget applying other parameters and metrics to be able to get any basic sense of valuation. So that's how important the business life cycle is. Now, in a bit more detail, what this tells you is that at a startup stage, most of your value comes from the future growth potential, as many of the participants rightly mentioned. And then as you mature, it will come from existing assets, as well as growth will still dominate. And then in the declining phase, or at a sort of mature sort of stage, which is like mature stage, almost entirely the valuation will come from the existing assets. So this is how you need to understand before you start working on a template-based valuation, just but looking at 3 years of past history and then making some projections and then starting to work on your valuation. So your horizon period itself, which generally I'm asked this question, how long should the horizon period be? Should it be 3 years? Should it be 2 years? Should it be 5 years? Should it be 20 years? And you will, when you look at it, you will understand that it's not a straitjacket answer. It depends on the size of a company, the size of the market. What is the market share a company is having? What's the total available market? What is the addressable market? What is the obtainable or serviceable market? What is the industry cyclicality? What are the entry barriers in that industry? What is the momentum mode? For example, times where you have high liquidity gush. So your projections will be only as realistic as you're able to factor the momentum of the market also. If the market is in a panic, there's no point in having a hunky-dory rosy picture for your projections. It won't work. The quality of your management, your intangible quotient, the macroeconomics, then extraneous periods like COVID-19, and then growth stabilization. How will your growth staging happen, right? Will it be a straight upward movement, or it will be staged? Your growth for the first 2 years will be normal. Then second year to 7th year will be phenomenally high. And then you will still continue to grow, but at a tapering incremental rate of growth. And after let's say 10 years, it will sort of moderate, and then it will become like a mature growth rate. So there are so many interplays. You need to understand all, the composite mix of all these factors just to arrive at one or two metrics. One is how long your horizon period should be. And during that horizon period, how will you stage your growth? Okay. So here is an example of a 2-stage growth model and a 3-stage growth model. If you look at a 3-stage growth model, you see first in time 1, there is a high growth rate, which is G1. and then there is a time 2. So between time 1 end and time 2 end, you see that the rate of growth is declining, and then it stabilizes at the end of time 2. So if you were to use your horizon period from 0 to time 2, and you have to factor the staging of the growth. So there'll be very high growth rate in T1. There will still be a high rate of growth, but not as high as T1 in T2. And then the growth rate will stabilize. So this is called a 3-stage growth model. Once you understand the growth staging, you will realize how important it becomes to make your projections in the first place. In cases where you have mature companies regularly declaring dividends, the easiest formula that I can give you is take the dividend and divide it by the rate of return, and then you get divided by the expected rate of return, and that will be the the valuation of a company. This is a derivation which for today I will not get into because that's quite simple. Yeah, so the terminal value, after the horizon period, there's a concept of terminal value. Now, how you derive terminal value, again, the premise of valuation comes into picture. If it's a liquidation premise, then it's a realizable value. If it's a going concern, then either it can be a value multiple or it can be the normal, the terminal value formula, where you use the end of the horizon period free cash flow, and then you divide it by the difference between your weighted average cost of capital and growth. So that's how you derive for an DCF intrinsic. So terminal value itself can be computed in so many different ways. Depends on the premise, depends on whether you're following market approach or income approach, and then depends on whether you think you want to exit it and then not exit it at a particular multiple which is predetermined. In that case, you'll use the liquidation premise. After a couple of years, if you feel that you're going to exit, then you can use it. So this was just summarizing how at an enterprise value based computation of valuation, you start from your EBIT after tax, and on the green side are the factors that you add to the value. On the red side are the factors that you reduce from the value, and then you arrive at the free cash flows to the firm. Those free cash flows to the firm are discounted using the weighted average cost of capital of the enterprise, and that's how you get the enterprise value of the business. Same way, it's a different way of showing the formula. It's for better recall. Same way, if you're using direct way of arriving at free cash flow, direct equity valuation, you start from the the net profit after tax, and on the green bucket, whatever you see, these are the factors you add. On the right hand side, you see the red bucket, these are the factors you reduce. You arrive at the free cash flow to equity, but this time in the discount rate, instead of using WACC, you will use the cost of equity, and you will straight arrive at the equity value. But if you use the earlier metric to use your free cash flow to the firm and then arrive at the free cash flow to the equity, then this table will tell you how you will get from your firm value to equity value. So you will start with the enterprise value, and then you add the cash and marketable securities, and then any idle or unutilized assets are to be added, then reduce any interest bearing liabilities, lease commitments, any kind of unfunded obligations, and that's how you'll arrive at the value of equity. So this is an indirect way of arriving at a value of equity if you were using the free cash flow to the firm and discounting with weighted average cost of capital. If you were using free cash flow to the equity directly and using the cost of equity to discount, you will straight away arrive at the value of equity. No need to get to this scheme of things. There are some expenses which can be considered for CAPEX cash flow in valuation. Now think about professional practice firms like the likes of Big Four or any sort of service-oriented business. Your human resources, the cost that you spend on recruitment, training, selection, employee welfare, recreation, that's the biggest value quotient for you. And you feel that the continuing cost that you are incurring on your HR is going to pay you back not just in that period, but over an extended period of time. In which case, a portion of your HR quotient, HR expenses can be capitalized for professional services firms. Let's say in the retail game, let's say, for example, Amazon, you're spending so huge on advertising, so huge on promotions. Even your discounts are actually negative for you on some time. But the impact of that will be that these customers that you're able to get will have a long loyalty period with you. So a portion of those advertising expenses can be capitalized particularly from a valuation perspective. Let's say a pharma company, you're spending so high on research and development. Some of the pharma companies also invest around 5 to 8% of their annual revenue on research and development. So that's a huge expense block. But for a valuation perspective, you can add back a portion of that expense, which is R&D, because for a pharma company, their product pipeline and their R&D phase, if they are able to pass through the clinical trial phase, and if they are able to apply for and then get the patents for those drugs, there'll be huge benefits for the next 17 years or 20 years as the patent regime is. So the R&D expenses, a large portion of that is capitalizable from a valuation perspective. This is just the normal way of depicting, your weighted average cost of capital. So it's got components of cost of equity and cost of debt, and then further breaking them into buckets. This is very basic. Cost of equity itself, we understood that it is a factor of 3 components, which is risk-free rate and then beta times market risk premium. We already discussed it. This is the same concept as a formula, cost of equity. This slide is very important, so I thought I'll explain this slide to you. So there are systematic risks and unsystematic risks. So normally you start with a risk-free rate of return and then take the beta times market risk premium, and you get your cost of equity, which you can use for discounting the free cash flow to the equity. But then all the companies are not of same size. And normally when you are doing valuations, most of the companies in the world are SMEs. For example, by one statistic I was told, India has around 60 million SMEs. 6 crore SMEs. So I think they're by far 90 to 95% of all the companies in the world minimum will be SMEs. When that happens, normally when there are smaller firms, they don't have smart systems, they don't have established ways of doing things. You'll have a mix of personal expenses and corporate expenses. You'll have compliance issues, you don't have transparency, you don't have visibility, the projections will be an issue, the risk factors can be higher, right? You don't have access to capital as much as large firms do. Because of that, you need to add an alpha premium to the cost of equity, and that's called small firm premium. Normally, it's anywhere between 3 to 5%. That's the extra premium that you add. Then in addition to that, if there are other factors which are peculiar to that company, which are otherwise not the case amongst the market participants. And that's why you need to do a risk profiling of the company and then benchmark it, compare it with the peer group. If there are exceptional risks, you need to add further alpha premium. So this slide is very important because you cannot plain vanilla just say, okay, I used CAPM and I got the valuation of a company, because the vast majority of the companies you will be valuing will be SMEs, and you will need to add the alpha premiums there. I think this will be my last slide for today, and then I'll be opening up for Q&A. I'm sure Prabdeep is waiting to stop me also, but I think this will be relevant because this gives you again a pyramid way of thinking. So as a pyramid, if you start from bottoms to up, the bottom being startups, and then small private, then large private, then small public, and then large public. Generally speaking, your expected discounting rate will go from high to low as you move from the bottom to the top. That's because startups, you have even survival issues, even your business model validation issues. In small and private, I already explained to you what are the kind of peculiarities that you would face. And as you get large and public, your access to capital, number of people who are interested in investing in you, standardized procedures, systems, you can hire any talent in the world. So the risks are minimized. And then you can have better call about the future visibility of the cash flows and projections. So the expected discount rate, or the cost of equity, so to say, to discount the cash flows as you go from startups to small and medium enterprises to large public companies will go from high to low. I mean, I will have many other slides to share, but I think in interest of time, I'll stop here. But it was amazing to deliberate this session along with all of you. And I was actually spellbound with some of your responses, because for most of my questions, I had almost all the contours of answers that I could think of. And I'm happy to take for the last couple of minutes any specific questions that you have for me.
Thank you so much, Naresh. We have with us our committee chairman, Central Council member CA Hansraj Chugsa, and very warm welcome to sir. We have, more than 20 questions. And we have very wonderful comments which students are typing. Jitendra Anadi. Jitendra has specifically written, please read it out, sir. It's a very long comment, like Preeti had written, I think, on the first or second day. So apologies, Jitendra, there is no time to read it, but thank you from the core of our heart. With this, many thanks to Naresh, and I request and I tell all participants that we will work it out to answer all your questions as the time does not allow. So therefore, apologies for it, because we have just 8 minutes left. And I pass it on to Chugsa. Thank you so much, sir.
Thank you, Pratyush.
Yeah, thank you, Pradeep, for such a wonderful program you carried for the last 7 days. Today is the last day or valedictory session we normally talk about. It's a really great, the subject, the way it is been elaborated with by today Naresh ji for such a, I was just here in the last few minutes, but the way you have really been taking it forward, it was a wonderful, and I really appreciate the today's need for the business also to understand whether it is at the startup or the large corporates. The valuation matters, the corporate finance or the understanding of the corporate words, how to be funded with and what value to be created with, so that it really bring back, though everyone rightly said, that once you born, so things are different. And once you mature or the initial stages or the stages, it comes down. So it everywhere, the things has to be different. Like today, if we talk about I being there at this stage, so I am different. Once I was there like a participants, those who are the participants of the day, maybe in the age group of 21 to 25. So things were quite different. So it's a journey. It's a journey for the corporates. It's a journey for the individual that matters. And naturally today being the valedictory session, I thought of let me have just 5-7 minutes to be spent with the participants, and my compliments and thanks to all these speakers all across these 7 days. Whether you today, Naresh ji, today, those who have brought us so many good things related with the business valuation and the finance side for the corporates. I'm very grateful and thankful to Naresh ji for your kind presence here and sharing the best available with you to the participants on behalf of the participants, on my own behalf, and on behalf of my co-chairman and the committee. I'm really very grateful and thankful to you. The person who is really with us, Nirlep ji, who has brought so many speakers around us, I'm very grateful and thankful to him also, because he is the instrumental in making this program a success. bringing out best of the speakers, coordinating and taking care of our Pradeep and my committee secretary also along with. So I'm very grateful and thankful to Nirlep bhai. Thank you to you also. The yesterday we have seen like TP Anandji, who has been spelling about, who has really given us the understanding macroeconomic business environment and the sources of the competitive advantages. Basically, you see like in the corporate structure of the non-corporate business community, it's there are the certain things which goes common, which are really been, and it is well said if the understanding of the economy and the growth goes accordingly, if you have a clarity, if you have a better understanding, so you are automatically the system system driven things will be maturing with. Otherwise, things will be going like you also said with like SME segments. There is a high risk because they do not go and something personal comes on the way. But if we talk about the corporate structure, the things are little system driven. There are the corporate structures, there are the governance system, there are the regulatory mechanisms. So there are so many benefits. So those understanding with the strategic kind of things and with the better understanding of the economics yesterday given by TP Anand Saabji, I'm very grateful to him also for coming and sharing his time. And the day before, strategic cost management and the management decision making by Rasita Putia. He has also, the faculty has brought so many good things around us. On behalf of the participants, I am very grateful and thankful to the communication skills, including advanced business communication, oral and written, individual and the group dynamics, working in team. Those were being brought into by Singha Raju and the Meenakshi Sundaram. That was also being brought in a best of the manner. So many praises has come from the participants. So many praise has been received from the different faculty within the faculty groups also. So those are really giving us the encouragement ki it is not the first and the last program. It is a continuity, though it's been started with. Now we have to continue with so many other programs in the time to come also, with the support of the faculties, whatsoever is been there here, or whatsoever we have to given attention for the new one also. So same way the Rajiv Hira and the Jayaprakash Agarwal ji, they also brought us so many good things. Financial statements analysis matters for the each and every professionals, whether it is the younger ones, the parties of the age of the participants, or the senior ones like me also. Unless until we have a good analytical mind or analytical understanding of the financial statements and the financial informations, so we cannot prove ourselves a good professionals. So those kind of understanding to be given with by Jayaprakash ji and Rajiv ji, that has also brought good things in the clarity in the minds of our younger friends. So I, on my behalf and on behalf of the committee and on behalf of the participants, very grateful and thankful to them also. Same way, Amit ji and Anand ji, they have brought us managerial and the business skills and the challenging accepted, the power of the professionals. Power of the professionals or the management and the business skills, whatsoever is being required with, that also goes along. It is not the starting points. All across the, whenever you grow with, at each and every stage you have to bring in the system so many better understanding with all clarity. So those are really been great subjects which has been taken forward by the Amit Arora and Anand Soni ji. In the very first session, I was also there for quite some time in the initial phase. Then Gulneet and the Girish Jain, they have really brought us so many interview and the interactive skill mechanism. I am very grateful and thankful to Gulneet and Girish Jain also for taking us and giving the best of the benefit to the participants in the best of the mechanism, best of the manner. I, on my own behalf of my co-chairman Durgesh Kabra ji and on behalf of the participants, all through these 7 days, I am very grateful and thankful to all the faculties available, all the time given by Nirlep ji, and starting with so many coordination and naturally the thanks to the Prabdeep and my secretary of the committee, Ranganathan ji also, for taking this forward. And believe me, so many appreciation are directly been received from so many participants. Though participants may have been in their own mind to discuss something different also, but the EDP was the starting point. You see, like sometime we also go strategically. We have to discuss anything with the, so then we start with something different. So today's professionals are very smart enough, whether it is the younger ones, they start with the appreciation and they come out with some kind of issues also at the same time, with some issues also. But it is the game, naturally, that shows the attentiveness and the attention of the participants. I'm very grateful and thankful to the each and every participants, those who have remained all the 7 days, or those who could not because of the some reason or the other. Because you see, like it is generally happened on some day or the other, you get some other engagements also. But all these 7 days programs are available on the ICAI TV also. If someone has missed it, some participants could not see all the 7 days, so they can see on the ICAI TV. They can spread the words around their other friends also, if someone has missed it. So friends, just to have a little notice of the this participants, we have so many good programs for each one of you. Now you see, like the test part, if we really understand, you all are going to face some kind of the interviews or some kind of interactive discussions with either as a going to be as an interviewer somewhere. So you have to go for some kind of the test, like ICAI, this committee for member in industry has planned for you some kind of the virtual interview sessions also, some psychometric test also, which all is free for each one of you. Because we want each and everyone to be made employable, each and everyone has to be made more strengthened, whether it is mind or whether it is the intellects. So with these kind of ideas, and more so, we have another program like mentorship program also, mentor-mentee relationship. So you all as a mentee can find out, you can register with the CMIB on their portal, mentor-mentee portal, and you register yourself. Mentors are also being registered there. So both can join hands, both can combine together for your own personal growth also, and the growth for in the futuristic mechanism also. With these words, I am very grateful and thankful to each one of you. Thankful to the participants, thanks to all the faculties, thanks to the organizers, Prabdeep and my secretary of the committee, Ranganathan ji, and special thanks to Nirlep Bhattji, who has really been kind enough to bring out so many good things around us. So I'm very grateful and thankful to you. Over to Prabdeep. Prabdeep, for the...
Thank you so much, sir. Thank you from the bottom of my heart. Also, I would like to thank all the participants. Your encouragement makes us happy. Many times I came out with different points on in the beginning, thinking how your mind is disturbing you, and I also tried my best to share some thoughts. So we all are available. You have been connecting with the faculties. And do not worry, all your queries will be resolved. All the contents which you have to receive for all the 7 days will be received to you. The most foremost important thing for us is that you have to succeed in your interviews, which starts from 5th, and very best to you all. Many thanks to G. Ranganathan sir. G. Ranganathan sir, is there any message for students?
No, but we just want to thank them for being with us for all these 7 days, and we'll be extending this program. There's a message for our speakers that we'll be extending this program for the earlier pass outs also, those who sat in our November 2020 batch. So we'll be contacting you for this, subject your time commitment, time availability. We'll be holding that program. Thank you so very much for being with us for all these 7 days. Thank you.
Thank you. Thank you. Thank you to each one of you. Please stay safe, take care, and good night. Goodbye. Yeah. Girish, you can